I'd like to bring to the show Christopher Verrone, Strategic Research Partners. Good morning, and thank you so much for joining us.
Good morning. Great to be here.
So we've heard pretty different opinions when it comes to the trading frenzy, the ready trading frenzy that we saw in the past 2 to 3 weeks. I was wondering, how healthy was that for the markets?
Yeah, I think in our view it's kind of been, it's a little bit of a distraction from a lot of the other important stuff that's going on. And when I think about the GameStop frenzy or the Reddit frenzy, I think it really underscores the idea as market analysts. It's a reminder you can't be short stocks making 52-week highs, and conversely, you can't be long stocks making 52-week lows. It's a lesson in the sell discipline. It's a lesson in the buy discipline as well. And I think ultimately, while all the attention was focused on what was happening on Reddit and GameStop, there were a lot of other really important things going on elsewhere. Like, while our attention was on Reddit, bond yields were breaking out, the dollar was firming, discretionary was getting stronger. Those, I think, are the real stories in this market. I think the Reddit and the GameStop thing is a bit of a distraction.
So I'm so happy you brought up the bond yields. Let's have a very quick check on the 10-year Treasury. It's pretty interesting because it's the yield is getting higher and higher. I was wondering, what kind of number do we have to see in order to see a change in the equities landscape?
Yeah, I think that's the big question for 2021. And kind of our view is that the risk this year for equities is not things go wrong. The risk is that everything goes right. Because if everything goes right, and that means stimulus, that means vaccines, that means reopen, it probably implies 10-year bond yields are a lot higher than 120 or 130. Is it 160? Is it 170? At what level do bond yields start to weigh on equities? We suspect that will become a risk as we move through the course of the year. Our gut says something north of 150 or 160 begins to weigh on stocks, but I think it's less a question of the level and simply how fast you get there. One of the real interesting facts, there are 58 economists on Wall Street that have a published 10-year yield forecast for the end of 2021. Only 4 of them have a year-end 2021 forecast above 150. So one of our themes this year has been getting familiar with the right side of the distribution curve. Well, for bond yields, that means getting okay with the idea that you may see bond yields in excess of 150 or 160 this year. That, I think, is the big question mark for equities. At what level can they handle it?
That's extremely interesting. On the other side, yesterday we did see the S&P 500, which checked out a record close once again. What's driving the price action at this point?
I think what's driving the price action at this point is that we're in an uptrend and we're in a bull market, and things tend to go up in uptrends and bull markets. I think the big question, as we consider the next couple months here is, this is a market that seems intent on challenging Jerome Powell. This is a market that seems intent on challenging the Fed. What do I mean by that? Well, the language from the Fed has been they're not even thinking about raising rates, or it's not even in the cards until 2024. And I think the market's saying, okay, well, at what level are you going to change your view? Is it 4,000 S&P? Is it 4,200 S&P? Is it 4,400 S&P? At what level do we re-invite the Fed back into the conversation? So much like we asked earlier, at what 10-year yield level do equities have a problem? At what S&P level does the Fed get brought back into this conversation? I think that's a really important question for 2021.
Yeah, totally it is. And this certainly proves the central bank's role in equity, in asset pricing, that's for sure. So I was wondering if it's possible to have a reasonable target when it comes to the S&P 500 and the Dow until the end of this year.
I think in bull markets, the only reasonable target's higher. I can't tell you what the level is going to be. Frankly, 2021 reminds me a little bit of 2010. Think about 2010. We were a year off the crisis lows of 2009. S&P was up 13% in 2010, but you had 10% corrections. You had a 10% correction in February of 2010, and you had about a 15% correction in the summer of 2010. So you still finished the year up, but it wasn't a straight line. I think that's a reasonable roadmap for 2021. I think market will be up this year. I don't think it'll be a straight line. And I think the risk to the year, as we said earlier, are things go too right. Because if things go too right, bond yields probably go up too much, or crude oil probably goes up too much. I mean, think about oil here. Oil's quietly gone 45 to 60 bucks over the last couple months. At what level? Is it 70? Is it 75? At what level does that actually start to choke the recovery as opposed to support the recovery?
Yeah, the crude oil path is really incredible so far. Right now at $58 per barrel, it's up about 0.36%, once again above the flat line. I just want to have a step back because I want to ask you, what's the social media role in trading activity today? And I'm asking this in regards to the ready trading frenzy. Do you think social media are going to have even more important impact on trading activity and financial markets?
I think the path is certainly yes. I mean, if you think about the impact social media has on all aspects of our life, it seems only logical it will have a larger aspect on financial markets. And there's been this talk of this democratization of the stock market, or maybe stock market populism. I think there's other ways that the market's telling us that as well. One of our big themes this year has been the leadership from the average stock compared to the big stock, right? So if you look at a sector like consumer discretionary, Amazon is about a 40% weight in consumer discretionary. The average stock is now outperforming Amazon. We call that stock market populism. The average issue taking share from the really big weight. So I think a lot of these things that are going on socially, I think a lot of these things that are going on with Reddit and GameStop almost actually support this idea that the average issue is going to be taking some share from the really, really big weight. We see that in discretionary. We see it in technology. Now, these are all sectors where a couple stocks comprise 40, 50, 60% of the entire weight.
Yeah, I was actually also noticing that the big tech have been pretty quiet lately. Is this surprising at all?
Well, I think it's a question of whether these stocks are just pausing in their long-term uptrends, or are they being used as a source of funds to support a lot of the other stories that are going on? I think the jury's out on that. I think right now, if you look at like an Amazon, I would describe Amazon right now as almost a funding short for the rest of consumer discretionary, right? We've seen money come out of things like Amazon. We've seen money come out of things like Facebook, and they've supported the other stocks in the sector. Now, the individual names and the individual charts are not that bad on their own right. It's a question of leadership. Are the FANG stocks, are the Amazons, are the Facebooks, are they going to return as the same leaders in the next couple of years that they were in the prior few years? And that's where I would say probably not. I think we're seeing enough from other corners of the market. Now, remember, this is a really, really broad market. I would go as far as saying this is probably the broadest market we've seen in 75 years worth of data. And when you're in markets this broad, it's not a question of necessarily what's going up or down. It's a question of what is leadership and what is not leadership. And that's where I think some of the FANG stocks are starting to lose leadership here.
Well, that's quite interesting. That's for sure. I want to switch to international markets, in particular Italian markets. So I was going through your notes and then I read markets like Draghi, which is true. We've heard pretty different opinions about that. Specifically, many analysts are saying, all right, what we're seeing is totally exaggerated. But I just want to show once again the bond market board. It's extremely interesting. The 10-year Italian is at record lows. Of course, I'm talking about a yield at 0.4, and the spread between the 10-year Italian and the 10-year German is at 90 basis points. And this is also certainly a great accomplishment just in 2 weeks' time.
Yeah.
So I was wondering, what are your thoughts? Do you see anything attractive as a sectors or as asset classes when it comes to Italy?
Let me make a couple observations on Italy, and then I'll kind of put it in context of broader Europe. I think with respect to Italy, if you look at Italian-German spreads right now, they're the lowest they've been in about a decade. So at this moment, the market perceives the threat of Italian default or Italian troubles in the bond market to be very, very low. I think that's supportive for the stocks. Now, you look at the Italian stocks, the FTSE Mid, right? It's been in a range for about 12 or 13 years. Italian stocks have been sideways in about an 80% range since 2011, 2012. My view would be, given that credit continues to improve, given that sovereign spreads continue to compress, that's probably a pretty good catalyst for the equities to actually start to work here. And if there's an area within the Italian market particularly that I would focus on, look at some of the luxury names. A name we've been talking about in our work with clients is Moncler. Very much part of that European luxury group of stocks, along with LVMH in France and Hermes. Moncler is breaking out of a big base. It's a leadership stock. I think it speaks to the idea that European consumer discretionary, Italian luxury stocks, French luxury stocks are leadership in this market. One of the relationships we look at, particularly in Europe, is discretionary versus staples. The idea of what is the risk on consumer name doing relative to the risk off consumer name. We like the European consumer discretionary stocks, particularly the luxury names, of which you could find some at home in Italy.
So can we add Ferrari to the luxury stocks?
Absolutely, and it's been a good chart. It's been a winner.
Yeah, it's been doing a great job. Let me ask you one final question. It's about a Bitcoin, because Bitcoin is like, or you love it or you hate it. So how are you positioned?
I'm long. I like it. I don't quite think I understand it yet, but I'm a speculator, and I like good charts. I like good trends. Bitcoin satisfies both of that. I think from a macro perspective, it's appropriate to think of Bitcoin as one of the real posters of liquidity, or one of the real barometers of market liquidity. The idea that Bitcoin probably exists today because of all the liquidity that's come into markets over the last 10, 11, or 12 years. So if we're looking for a signal on liquidity, whether liquidity conditions are tightening or whether liquidity conditions are still supportive, Bitcoin's probably an appropriate place to look. So I see Bitcoin at new highs, 47.5, 48,000. I think that more than anything is a commentary that the liquidity condition of the globe is still in pretty good hands. If you start to see Bitcoin crack or underperform, that I think would be a sign that there's liquidity issues going on elsewhere in the world. So I like it from a chart perspective. We're long from that context, but I also like it as a bellwether. I like it as a barometer of risk appetite. I like it as a barometer of liquidity.
All right. Thank you very much. Christopher Verrone, partner at Strategic Research Partners. Thank you so much and have a great weekend.
You too.